Hi, and welcome to Two CPAs and The Mic, the podcast where we talk tax, finance, and all things related to business. Whether you're a business owner, working professional, or someone who wants to start a career in accounting, this is the podcast for you. Hosted by CCK Strategies partners Jeff Frable and Sara, we dive into relevant business and tax matters with working professionals to make these topics less intimidating, relatable, and dare we say fun? Let's get down to business.
Welcome to another episode of Two CPAs and The Mic. I am Jeff Frable with CCK Strategies, here with my trusty cohort and co-host, Sara. Hello, Sara.
Hi, Frable. I do not like a cohort.
You don't like cohort, do you? It's kind of hard. It doesn't roll off the tongue very well.
No, it doesn't.
Well, we're glad you're on, as always, Sara. And on the other mic is Christy. Hey, Christy, how's it going?
Hello, team.
Hello and good morning.
Well, it's a new day, and hello.
Hello. Yes, it's a beautiful day.
It's going to be a good day.
It's a beautiful day in the neighborhood, for sure. Well, we're glad you joined us today. If you haven't joined us before, we cover relevant business and tax topics. And we try to do it in a way where we apply straight talk, practical information, and don't use all the jargon and stuffiness that's normally associated with our industry. After all, you may look and say, two CPAs and a mic, how boring. But no, we like to have some fun. And so we've introduced Sara and KP. Today, we're talking about the value of estate planning, and we have a very special guest with us today. So as we always do, if you're lacing up your shoes to go on a run and you are a business owner, you definitely need to be listening today, because we're going to talk about ways to protect your assets and to save some tax. And if you're in the profession and have no idea what estate planning is, you definitely should stay around, because we're going to have some fun talking about it this morning. But with that, Sara, would you like to introduce the person on the mic this morning?
Yes, I would.
I see.
You had a little robotic at the end of that.
I'm trying to slow it down a little bit.
Well, yes, today on the mic, we have my partner in crime. We became partners the same time this year, Dewan Chowdhury. How are you doing, Dewan?
I'm doing great. Good morning, everyone. Thanks for having me here.
Good. Hey, so Dewan, you've been at CCK how long now? 8-9 years?
8 years, almost 8 years now.
8 years in December, right?
That's January. It's going to be 8 years in January. So
January,
in a couple of months.
Okay.
But time flies. I feel like it was just the other day. We just started.
Right? I know. And Dewan, cool part about Dewan, just a little background as far as his professional career here at CCK. He was one of the pioneers of our Frisco office when we opened up down in Frisco. Yeah.
What a journey.
Sara, give just a little bit of that background, because I'm not sure we've gone very deep into that before. So just a little bit of background of the second location and all that.
Yeah. So we opened our second location, coincidentally, 8 years in January at the same time Dewan started. We've always, and it's still a part of who we are, want to expand if the feel is right.
Yeah,
yep.
Absolutely.
Good word. Feel, opportunity. Yeah. And we had a great opportunity to open our office in Frisco, and Dewan was our very first hire, really. Right.
He was our trailblazer. He was the one.
Blazing the trail in Frisco.
Okay, so that's just a really good segue, Dewan. Let's give a little brief intro of yourself. How did you land at CCK? And then we'll get into who Dewan is.
Sure.
Who are you really?
Sounds great. Well, I'm gonna stay with the professional career side of things. So with that said, I spent 7 years prior to CCK at Clifton Larson Allen. It's one of the top 10 accounting firm, and I had a great time over there, focused on healthcare and private client services. But I was at that point in my career where I was looking for a transition. I got married in 2016, and by the spring of 2017, knew it would be either family or work. Was going through those spring businesses and hours, and I was in the 80s and 90s weekly, hour-wise. A lot of times I was leaving work for work in the morning when the wife was sleeping, coming back at home when she was already in bed. So pretty quickly, had to decide as to, okay, either it's going to be work or the family. So I started to look for options and had conversation internally as to, hey, we need some changes and adjustment. And it did not happen, and I quickly found out that I probably need to look for outside of public accounting.
Right.
That's when I started some conversation with Christy. And I was pleasantly surprised on the culture. Culture was a big thing for me. I was saying, whenever I make that transition, it needs to be a perfect culture, at least what I'm looking for. The work-life balance needs to be a priority for me at this point as well. So came across this opportunity with CCK, established farm, a big farm here in Tulsa, Oklahoma, opening up office in Dallas and looking for people to help grow the office. So that was part of my background at CLA as well. I helped grow the office over there. When I started over there, the year before that, the farm acquired a small practice in Richardson, Texas. So during my 7 years, we grew from like 40 something people to 120. So that was part of my role over there. So it kind of naturally transitioned, and what a journey it's been here at CCK. I think I was one of the first four the first month we started, and now we're close to 40, I think.
Wow. And that's an 8-year time span. So that's pretty impressive.
That's great.
I remember, fun fact, I trained Dewan and worked closely with Dewan to help establish that office down there. I remember that first tax season, Dewan. It took you a bit to assimilate, to really believe who we were. And you were still working some pretty crazy hours too. Do you remember?
Oh yeah, for sure. Again, that's with transition, right?
Yeah.
As soon as we establish a good team around us, things get easier. It's the growing pains, but we signed up for it, and we have some good team members now and good team around us now.
That's right. Yeah, that's right.
Sara, you know what I remember too? I remember talking about this with Dewan, and probably you as you were training, that when we onboard other professionals who've had experience, it's really important for everyone to remember that there's almost a detox phase that takes place. And Dewan, I'm going to remember that if anyone is ever needing to have some encouragement during that process, I'm going to remember that you're the guy to talk to.
No, I'd be happy to have some conversation. I've definitely gone through that process.
Yes. All right, Dewan. Let's talk about who you are personally. So you're not originally from the United States. Where are you from?
Yeah, no, I'm not. Actually, I was born and brought up in Bangladesh. I think growing up, I kind of knew that I will at some point move to the United States. I think the process was about 10 years.
Oh, wow.
So one of my aunts, they actually applied for our family to migrate over to the U.S. And it's a lengthy process. So I've known for a long time, at some point, we're going to move to the United States. So with that said, the timing could not have been better. I just finished my high school and I was ready for college. And at the time we transitioned, we moved here to Dallas, Texas, and it's been 20 years. So started at SMU, finished my undergrad in accounting, BBA at SMU, then went to University of Texas at Dallas for my master's focused in tax. So that's how I kind of moved over here and got into accounting.
Okay, so getting into accounting. So I learned something new about you just recently, that you had to pick accounting like when you were like 5, right?
When you came out of the womb. Pick a career.
That's how it feels like. So actually, you know what? The schooling system is so different back in Bangladesh. It's similar to what they use in England, in the United Kingdom. And what they have, the process that they have is for you to sit for your 10th grade exams, you have to pick the topics and subjects that you want to focus on. And you have to do that after your 8th grade. So 9th grade, 10th grade, you study for those, you sit for those tests, you pass that, and it's called O-levels. And after you complete your O-levels, then you qualify to sit for your A-levels. That's usually the 12th grade test. So
Oh,
by
but
the
it's Olivos?
like
O
ordinary.
levels, O level,
Oh, like
and A level.
like
Is that right?
OWL?
That's right.
Like in
O
Harry
as in
Potter.
like ordinary level, and then A levels as in advanced. So
Okay,
ordinary
okay.
and advanced. That's how they kind of classify the two.
Sarah, it's not Harry Potter.
I thought you said OWLs.
No, so essentially before the start of the ninth grade, I had to decide what do I want to study. And at that time, I was actually pretty much selecting everything in the science area. So it was
Okay.
physics, chemistry, bio. So those are all the classes that I was taking. And I had some close friends. They were like, you know what, we're going to actually study business. So they were taking all the economics, finance, accounting classes. I had decided, okay, let me take a class that I can just go and hang out with them. So that's how I decided, okay, I'm going to take an accounting class as well. So that
And
was
what
my
grade
ninth
was
grade.
that? Was that
Ninth
ninth
grade.
grade?
That
Ninth
was
grade, okay.
That was ninth
So,
grade.
so Dewan, not to really change direction here, but when you were telling us this, we were like, oh yeah, and it's really, I mean, 13, 14-year-olds have the mental capacity to choose their career going forward. But what is that like? Is that like a tradition and it's a big deal, or how many young men and women like stick to that selection, or are you stuck? I mean, how does that work?
That's a great question, Jeff. We get used to our surroundings very quickly, right? So as we grow up and we see that's the process, we just get used to it. We don't think any different. Here, starting in the US, starting my university life in US, I had so many friends, they were undecided. The first year or two, they didn't decide what they're going to study. Even like the third year, junior year, they were like, no, actually, I'm going to change my major and do something different.
General studies.
That's right. So that was a foreign concept to me. So growing up, it's a lot of pressure. It's a lot of pressure. And a lot of that is guided by the parents. A lot of that is guided by, the mentors, the teachers that you are close with growing up in schooling system. But yeah, so think about it this way. If I had not taken accounting class and I had graduated with my O levels and A levels, I would have finished my high school and started university without any accounting background, any business background. It's very difficult to switch afterwards because you have no background at all. Yeah. You don't have the basics to even start at that point. So what you decide on your ninth grade, before your ninth grade starts, is very important. So a lot of people that's why a lot of people kind of stay in both areas where I am undecided, unless someone knows, hey, I want to be a doctor when I grow up, right? I want to be an engineer when I grow up, or I want to be a CPA when I grow up, right? So unless you have someone like that, they kind of spread it around a little, have a bigger base, and then kind of decide as they grow and move up.
Yeah. Okay. So you've been in public accounting since you were 5. So what, and you mentioned earlier, back at your previous employer, you were in healthcare. Mm-hmm. And Jeff already mentioned the topic today. We're going to be talking about estate planning. How's that morphed into you really diving into estate planning? And really, I mean, honestly, I see the passion just in our day-to-day and hearing you talk about it. What led you to want to really dive into estate planning and helping others?
That's a great question. So when I said I focused in healthcare at my prior firm, the people that I worked with were physicians, doctors. So I was actually one of the person leading the physicians practice. So if you think about physicians, high net worth individuals, right? A lot of wealth they're building as they're moving up in their career. The estate planning kind of comes naturally from there. Okay, what do I do with this wealth? How do I transfer that to the next generation? Starting at CCK, I had a good client base, and I would say there are 4 areas that I focus in. So in the last 8 years, that has become my natural fit and industries that I focus in. Healthcare still being one, real estate is the second one, family offices. So I work with a lot of family offices. And when I say family offices, some also includes, those doctors and physicians.
Right.
And they're later on in their career, we're like, okay, we're now just going to invest and create a family office. And whenever we talk about family office, sometimes there are multiple generations involved as well. So the fourth piece of my specialty is the estate planning, kind of comes naturally from that family office because that's one of the goals.
May I ask a quick question? I'm going to
Sure.
interrupt just for our listening audience. Can you give us a definition of family offices?
Sure. So when we talk about family office, essentially we're looking at a family or an individual who are mostly focused on investments. And this family office, this back office, manages all those investments. They, stay on track of what's happening with those investments, what are new deals to get invested into, what are good exit strategies, when to come out. So these are the things that the back office is doing with the family.
Thanks.
Good. Okay. So also just to piggyback on Christy's asking for our listeners, let's get into what the meat of this is. Like, what is an estate? What are all the things included inside of an estate?
Great. So if you actually do a quick search on what is an estate, because in our world, when we do taxes, a lot of the times it's the income tax that we're talking about, right? We work with business owners, we work with investors, entrepreneurs, and we work with their business returns and personal returns. We don't probably do a whole lot of estate planning unless there's a natural need for our client. So this might be a foreign concept for a lot of listeners over here who might also be practicing in tax, right? So if you just do a search for what is an estate, what you're going to see is it's basically your net assets. Your assets less any liabilities that you have, that is your estate. So on a given day, if you try to figure out what is the value of your estate, that's what you're looking at. What is the market value today of all my assets and liabilities? The net of that is your estate.
Good deal. Okay. So when you have this estate and you hear people talk about, I need a plan for this, or I need this, or I need that. What is estate planning entail? If high level, what is it when you need to get into the meat of an estate plan?
So before I actually say what is included in an estate planning, I do want to mention why. I think that's a good starting point as to why it's needed. We all work hard, right? We all work very hard to build the wealth. And as we move up in our career, obviously the goal is we're going to build more wealth. But how do we transfer this wealth to the people that we love, to our next generation, to our family? How do we make sure that the people that we care about, the people that we love, are taken care of? That's really the whole goal of this estate planning. That's why this estate planning is needed, because the wealth that we accumulate, we want to make sure that it goes to the people that we love based on our wishes. If we don't,
key word.
That's 100% the key word. If we do not document how the estate should be transferred, at that point, the state steps in if something was to happen to me. The state rules will dictate what happens to my wealth and how those assets are going to be divided up and who's going to get that. So if I have a good estate planning, doesn't matter what my wealth is, doesn't matter what my estate value is. If I have a good estate planning that says how the wealth will be and the assets would be distributed out to the family, to my friends, whatever that is, based on my wishes, that's truly what that estate planning, where it starts.
Right. So
it's how you transfer these assets to your friends, your family, and your partners, right?
That's right.
Okay.
Again,
I was just making sure.
That's also a big part of it, right? You are a partner in a business. What happens to that ownership if something were to happen to you, right? So we work as professionals. One of the bigger portion of the client base that we have are business owners. What happens to their businesses? That should be a factor to consider.
So when you say, you said it, but just to make sure our listeners understand what's included in an estate in estate planning is the transfer of all assets, not just some. And assets include, and interrupt me, Dewan, if you can think more, but I'm thinking of home, bank accounts, any investment accounts, any other investments that you've made into other ownership of a C Corp, LLC, S Corp.
You got it.
Anything.
You got it, Sarah. That's exactly right. Anything that you own,
Hard.
As small as I have a bank account, you have an estate.
Yeah.
So retirement plan accounts, you're right. All of those are included within the estate. So if
Insurance
something,
proceeds,
sorry,
life insurance proceeds.
100%, 100%. 100%.
Yeah.
So the goal behind you asked, how do you start the estate planning process? I mentioned why it's needed, but between the why and what's the process, the goal really is to make sure that the wealth gets transferred efficiently, and you want to pay as little tax as possible, right? That's one of our focus.
Yeah.
We want to make
Right.
sure that we're paying as little tax as possible. So one of the things that we will talk probably in a little bit is who pays taxes. But the estate planning is needed for people who might be paying taxes and also people who might not be paying taxes because of the reasons that we talked about. Because again, based on our wishes, if you have estate planning, our assets are going to get distributed out after we're gone.
So what do you say to
Sara, can I just jump in here real quick? Because I want to point out an issue or a difference, because you kind of mentioned it in passing, but we are not talking about buy-sell agreements or agreements between partners of a partnership or members of an LLC or shareholders of a corporation. That's a whole other topic and a whole other issue. What we're talking about is, because of you doing a great job of planning in those areas, your estate has received a financial liquidation or a financial benefit from that transfer. And then it's what you do with those funds after that has occurred. That's fair to say, don't you think, Dewan? Because they are
Correct.
two different things.
That's correct. That's correct.
Okay.
So think about it as simple as this. Like, not everyone owns a business, right? You might not have a ownership interest in a business, but a lot of people own a bank account. A lot of people own a house. What happens to the house if it's under your name? So a lot of times that's one of the triggers why things go to probate. And what is a probate? That might be a question. Essentially, if you have assets, if you pass away without having a solid estate plan, especially with real estate, it would basically go to our state's court system, and they will decide what happens to those assets. And real estate is one of the triggers why things go to probate, why an estate go to probate. So if you don't basically say who's going to receive the real estate, or if it's not outside of your estate, things do go to probate a lot of times. So Sara, that's where the transition comes as to how do we start the estate planning process. A lot of the times it's as simple as, let's start a living trust.
Well, I'm going to back up just one question, because I know some of our listeners are maybe like, I have accounts that have beneficiaries. Why do I need to have an estate plan or in getting into a living trust and avoiding probate? And the answer is because not everything has a beneficiary tied to it. Or even with real estate, some of those titles may not be what's that word?
Joint tenancy.
Account. Yes, joint tenancy with right of survivorship.
That's right. That's right. So Sara, that's a great point. So each state works differently, and each states honor some of those that you were talking about, either joint tenancy or having a joint account on a bank account. If the state honors those system, and if you have an option to have someone else as an owner with you, they can actually take over after you. So again, each state has different rules. You can set it up where if something were to happen to you, your ownership gets split between all the remaining owners of whatever assets you own. So that's actually one of the ways you can create an estate planning. But that's part of the estate planning as well, because not everyone knows about it. So as you look at your list of assets, the first thing we do is we basically say, what do you own? Let's come up with a list of assets. And then we look at the state rules and basically talk about, there are easier ways to make sure that we have a joint tenancy on these accounts. And you don't have to do a whole lot with those then, because have someone else, maybe your spouse, maybe some kids included on those accounts. If something were to happen to you, they can step in, and then they can actually help with the distribution of those assets.
Right. Okay. So you get together, you make a list of all of your assets. And then what? Is that something, Dewan, that can you make a trust? Can you draw up a trust?
So we as tax professionals, we want to be involved in the process, but at the same time, we want to make sure the attorneys are there to draw up the legal documents. We're not lawyers.
That's right.
We want to make sure that we have lawyers that we're working with, but the documents are drawn up in a way where tax consequences are considered as well.
Good.
She was trying to set you up, Dewan.
Yep. Yeah.
No, that's a good question. Again, like we might have a lot of listeners over here who are not familiar with the process. So they need to know, everyone needs to know that it's not just one person doing everything. There might be multiple members. And honestly, I feel like as a firm, as CCK, that's what we're best at. We don't want to be that one person who's doing everything. We want to be a team member to our clients. We can come in and provide the value that's needed and work well with others.
Well, the other part of that too, Dewan, is that, sorry, Sara, the other part of that is we want to be, you mentioned we want to be part of the team. That doesn't mean we want to take care of everything and control everything, but it's not fair to the client for us to say, well, this really needs to be this way and that way, and then have them go to the attorney and say, and try to translate that and communicate it. That's why we like to all sit at the table together to have those discussions.
100%. That's right.
So what do you say when someone approaches you and said, I don't need a trust. I have a will. I'm all good. That covers everything. I don't have to go to probate. What's your answer to that question?
I say that's a great start. I say that's a great start. If you ask around, not everyone has a will. So if you have a will, that's a great starting point. And that's also part of your estate planning. The goal really is, how do we stay out of probate? So if we look at our asset list of assets, and if we say, hey, our will actually dictates what happens to these assets, great. As I was saying, real estate is one of the reasons why, even if you have that listed on your will, real estate will trigger an estate to go to a probate. So one of the things that we usually do is start a trust where we first move away the real estate outside of individual's estate. So when I say move assets away, essentially you're not going to own that asset anymore. The title of the ownership will change from yourself to a trust. At that point, the trust becomes the owner of your house. And we talk about living, the living trust, and that's one of the simpler and easier trusts that you can start your estate planning with. What it does is it basically says, and it allows you to move your assets, your house, bank accounts, or anything else that you own from your personal name into the trust name, where the trust becomes the legal owner of those assets. And that's how you can move away your assets outside of your estate, and you don't go into a probate if something were to happen to you. And the trust will dictate exactly what will happen to these assets when you're gone.
And the trust is pretty much the document that, just like you mentioned earlier, this is my wishes. This is how I want things to go.
That's right.
Can anyone contest a trust?
You can. But one thing that happens is if you establish a trust, and usually there's a trustee that's involved with the process. And let me step back and explain this process a little. When you establish a trust, you're the individual who's putting your assets into the trust. So you are usually the grantor. And you then have a trustee who manages those assets and your wishes that's within the trust. And you yourself could be the trustee for a living trust while you're alive. But once you're gone, usually you say who the trustee would be. That's usually someone else. Could be a family member, could be a friend. So that trustee would at that point basically allocate and do things per your wishes, per the living trust wishes. If we have a historic way of doing things, then whoever contested a trust's wishes does not have as much value versus, because again, like you have maybe 10 years of doing it a certain way. Someone cannot be just stepping and be like, hey, I don't agree to this.
Right.
Because we have written documentation that suggests the movement of those assets, how the trust acted during the grantor's lifetime. And it's basically business as usual, even if that grantor is gone.
Right. And since it's a legal document, it's really hard to
Correct.
to get around it.
That's right.
So Dewan, when I set up a trust and put my assets in it, am I losing control of my? Because you say that it's out of your estate and everything. Am I losing control of those assets?
That's a great question, Jeff. There are a couple of different types of trusts, and that's why we love to start off with the living trust. These are called revocable trusts. Essentially, you have the control during your lifetime to make changes. So you don't lose control. There are different types of trusts. So depending on what kind of assets you own and what are the goals of the estate planning, there are some irrevocable trusts that you can set up where you can put assets into it and you actually don't have control at that point. Whatever your wishes are for those trusts and the distribution of those assets, you're basically stuck with that at that point. And the nice thing about those living trusts is during your lifetime, you dictate what happens. You make changes. As soon as you're gone, that's when that revocable trust, living trust, turns into an irrevocable living trust. So that's when things get locked in.
Upon your passing.
On your
Right.
passing. Correct.
Okay.
Great question.
Okay, so we hear, especially when things happen in Congress and they start talking about tax law changes and all those things, there's the thing called that gift tax exemption and lifetime estate exemption. What is that, Dewan?
Okay, before I talk about that, I'm going to take a step back.
Okay.
Estate tax was not around forever, right? So it was introduced at some point. If you look at the history of estate tax, back in the 1800s, it was just introduced always usually for a short time frame. And it was usually always around when there was war. The government was trying to raise money, through taxes. So, and the fashion of that was different every time as well. Sometimes it was, the goal really is anytime there's a wealth asset transfer, there's a tax implication on that. So that's really what estate tax is. Whenever we talk about wealth transfer from one individual to the other, there's tax included. So in the 1800s, anytime they had war and the government needed more money, this was introduced for a few years and then it went away. So it happened a few times. Then I think in 1913 or 16, it was for the first time established as to, okay, we're going to have some estate tax going forward. And people were working around it as to, hey, and what was determined as estate tax was when you die. So that's the value of your estate on your date of death and how things were transferring, the assets were transferring from that individual to others. And that's what you got taxed on. And obviously we have creative people, smart people. So people started to think through, okay, how do we get out of it? And gifting became a big thing. Mm-hmm. People were gifting during their lifetime so that when you're gone, you don't have a whole lot left within your estate. So more regulations came on gifting, how gifting should be managed and taxed. So earlier, I would say in the 21st century, more regulations came up and both sides of estate and gifts got kind of combined together. And we had a holistic view of, okay, how does the entire estate planning should be considered and gift tax should be worked. So you asked about the exemption. I want to explain that from that particular background. An individual has a lifetime exemption. And what that means is the value of their assets, net assets less liabilities, if it's over a certain threshold, which is the exemption amount, they would pay tax when they're gone. Okay. Their estate would pay tax when they're gone. So people talk about, hey, you cannot escape taxes even if you're dead. It's true.
Yeah.
It's true. So if you have an estate and it's a taxable estate, which is the value of the estate is over the exemption, lifetime exemption threshold, you would pay a tax at that point. And in 2025, it's 13.99 million. And we talked about gifting during the lifetime. So that actually has an annual exemption as well. So it's 19,000 essentially for this year, for 2025. So annually, you can gift out assets. It could be cash. It could be any other form of assets from your estate to others, family members, friends, and get your assets outside of your estate. Up to 19,000 of gifting has no tax consequences. Anything above could potentially have some taxes tied to it. And
Taxes on the receiver or on the donor?
on the donor. So that's the nice thing. Someone who's receiving a gift, they should not be paying taxes, right? Because again, you don't have control of. If someone gives you money, I'll take that money. I don't know about you guys, but if someone gives me money, I'll take that money. But I don't want to pay tax on that money. That was my call, receiving receiving that cash. So I don't want to pay tax on it. So whoever is the donor, whoever is giving the money, is the one who would be paying taxes if it's over the annual threshold.
Okay. So part of your strategy, especially with the estate plan, is looking at those exemption limits and seeing where total net assets land for an individual or married filing joint together, and then working with those exemptions to help eliminate or not pay as much tax.
Correct. And I'm going to expand that a little as well. So I mentioned the individual gifting was $19,000. So say, for example, Sarah, you're gifting me $19,000, right?
Right.
So you don't pay any taxes on the $19,000, but you can be creative about it. Say, for example, I'm in need and I need $38,000 for whatever reason. We can be creative about this, where you gift $19,000 to me and $19,000 to my wife, whereas a household, we might be getting $38,000, but there's no gift consequences because, as I was saying, it's from the donor to the individual who's receiving the money. So sometimes we talk about gifting to families,
right?
Like, say, for example, if I'm gifting to my kids, and if the kid is married and has children as well, you can kind of think about that next generation household and gift it in a way where you can actually gift a lot on an annual basis and not have to pay taxes.
Nice.
Because the other part about that is you and your spouse can stack those contributions as well. So if it's beyond the 38 that you talked about, that Sarah could give you and your wife, her husband could do the same thing. So it could, in essence, double the amount of the gift from one family to another, in theory.
100%.
Right.
And that starts to add up over the years.
Oh, yeah, for sure.
So on that whole process of gifting, and we're not even talking about gifting to individuals. We're also talking about charitable gifting. Sure. So speak a little bit into that, of what kind of strategies are available for charitable donations and charitable gifting as it relates to the estate plan.
Yeah, so we work with a lot of clients. A lot are very philanthropic in nature. So we look at a lot of ways to, again, the goal is get assets outside of your estate, right? How do we do that? There are ways we can actually create trust. We can create LLCs, get assets outside of the estate that way. We talked about gifting, and donation is definitely one of them. If you're philanthropic in nature, if you want to, give back to your community, there are ways to do that. So one of the easy ways to do that is a donor advice fund. That's one that we utilize a lot in our tax strategies. The way it works is, say, for example, if you have a good tax year where you have a lot of income, if you put a big chunk of money into a donor advice fund, you get the deduction the year off when the money is put into the donor advice fund. But from there on, you have the control over paying it out from the donor advice fund to the charitable organizations over the next several years.
So they're not getting it all in one chunk.
Correct. So if you work with charitable organizations, and if you're making payments on a yearly basis, that can still continue. But if you have a big tax year, you can take that strategy where you're putting the money into a donor advice fund, and then over the next maybe 5 years, you're giving donations to those charities the same amount that you've done in the past, but in a given year you just get a big tax deduction. So that's one of the strategies. But there are other options on how that donation could be done. There are private foundation, there are private charities. So all those are options for how you can still be philanthropic and still have a good estate planning in the mix.
And I've even heard of charitable remainder uni trust, where there's even more structure to those kind of givings. But I would say probably the most cost effective is a donor advised fund. And then it gets a little bit more intricate once you get into foundations and charitable remainder trust.
Correct. Again, depends on what the goal is.
Yeah.
Things can be pretty complicated, depending on how you plan your estate and what's needed for your estate. So when we talk about estate planning, one of the big goal is how do we get assets outside of your estate where it's going to grow outside of your estate. Say, for example, let's actually use something as an example. Whenever we're looking at assets, we're looking for assets that appreciate quickly and move those first. For example, real estate. We've been talking about real estate. If you have a house, $300,000, and say, for example, in 20 years, it's going to be $600,000. If you try to basically move that asset in 20 years, your estate is going to take a $600,000 ding versus if you do the movement now. So you can move that asset, your real estate, 300,000 outside of your estate into a trust now. And the growth over 20 years is actually going to happen outside of your estate. So that $300,000, the doubling up of the real estate value over 20 years is going to be at the trust level and not your level. So again, there could be very complicated ways of why a trust is needed and how things are set up and what happens afterwards. But there are many ways it could be done. You mentioned the charitable remainder trust. There are trusts where you basically put assets in there. And the goal could be, hey, I want this organizations to receive $10,000 on an annual basis. So that's what they're going to get. And on the flip side, and usually there's a fixed time frame, either at my death or for 20 years, they're going to be receiving that $10,000. And at that point, if something were to happen to me or the time expires, 20-year expires, the assets would go to my family member or friends. So I dictate what happens to those assets. Still, I'm in control when I set up those trusts. But I also have, again, I'm philanthropic in nature. So I will say what will happen in my lifetime or over the next 10 or 20 years. So there are ways you can also use those trusts to still be philanthropic.
Okay, so even going further, there's besides, getting things outside of your estate and being philanthropic in nature and wanting to carry that on, there's other opportunities available in estate planning. And just thinking, we've talked about trust, but what kind of things do we need to think about when it comes to Medicaid?
That's a good question. Again, there are certain rules that you have to follow to qualify for Medicaid, right? So if you have assets over a certain dollar amount, if you have income over a certain dollar amount, you might not qualify. So there are Medicaid trusts that could be established, and you can move assets outside of your estate and into those trusts. Again, the goal is you qualify yourself that way. Your assets would be under the threshold. Your income would be under the threshold. So there could be structures that could be created with Medicaid in mind, with certain trust introduced to the estate planning. And I would say there are a lot of senior or elderly law practitioners out there, lawyers out there. They should be involved in some of these conversations and how they are structured.
Right, because there's even rules around timing for that stuff too.
There is. So, if you say, for example, create a trust today and be like, hey, I'm going to move all my assets over and I'm going to apply tomorrow. That's not how it's going to work. I believe there's a look back period of 5 years or so. So they're going to ask for questions as to what happened in the last 5 years. Did you actually move something over? Is this truly the value of your estate? So there are some, again, all of that needs to be considered. So there is a look back period when you apply for Medicaid. So you cannot just move your assets and apply the day after.
That's right. Okay, so Medicaid, and then we're got to look at multiple marriages too, right? And also the marital, when you're looking at, there's a marital deduction and then there's also multiple marriages. If I've been married 3 times, do I get 3 marital deductions?
Actually, you know what? This is a good question. But before that, I want to explain what a marital deduction is.
Okay. Fair.
So what we talked about earlier is when we talk about estate tax or gift tax, it's always the asset transfer from one individual to the other. That's when the tax kicks in, right?
Right.
So initially, when this estate tax was introduced, there was no marital deduction. So even if you wanted to transfer some of your wealth to your spouse, there was a tax that was involved. So the marital So this was introduced, I think, pretty shortly after the state taxes were in place, where basically you could transfer unlimited amount of wealth in your lifetime to your spouse and not have any tax consequence. That's what the marital deduction is. So the goal behind that is during your lifetime, if you if you have a spouse that's a little maybe younger in age or whatever that is, maybe you're not in the best health, there are ways you can actually transfer some of your assets to your spouse and not have any tax consequences, or you can actually establish trusts in a way where even after you're gone, the spouse will benefit from those assets, but the asset distribution still happens based on your wishes. We can use one example, QTIP. It's a short form for Qualified Terminable Interest Property Trust. QTIP is a famous one that people use, where the goal of that trust is you put assets in there to ensure that your spouse is taken care of during their lifetime. If something were to happen to you, those assets in that trust will kick enough income to take care of your spouse while they're alive. But if something happens to the spouse, at that point, the trust would say what happens to those assets. At that point, you can actually say, hey, these assets are going to go to my kids, right? At that point. And a lot of times, actually, this trust is used if it's a mixed marriage. If you have a mixed marriage, so you might have a second marriage that you're in, and the second marriage, the wife might actually have kids from her side or his side. So you might actually want some of the family looms or the assets that's been in the family forever. You want those assets probably to go to your side of the kids, and that's why you could create some of those trusts where you can say, hey, during my wife's lifetime, she can benefit from the income from those assets. But after she's gone, my side of the family, my kids will get those assets. So that's the benefit of those trusts.
Yeah.
Protection, 100%. So one of the biggest thing about those trusts is what we're saying is you're not in control if it's an irrevocable trust. So you do get a creditor protection. That's number one. So whenever we talk about estate planning, credit protection is one of the biggest things that we consider. You're not the owner. You're not, those are not assets that you have under your estate. No one can come and claim for those. But on top of those protection in that trust, it's basically your wishes.
All right. So wrap up question. We followed your advice. We got an estate plan. I went to my attorney, got everything all lined out. Am I done? Do I have to, I've got my packet in place. Do I ever have to look at those documents ever again?
I wish it was that simple. I wish it was that simple. Life changes. We change. We need to make sure our estate planning is updated accordingly. And when I say that, we can use a simple example as what we were talking about with QTIP, with multiple marriages. If you go through a marriage and if you had established estate planning prior to that, you might want to make some changes, right? Yeah. If you have a second marriage that you're getting into, you might want to make some changes as to who are going to be the beneficiaries. Is it still the first wife, or ex-wife, or, your current wife? Or think about it as simple as, hey, I just, my wife and I, for example, if we use our example, we started our estate planning a few years ago, 5-6 years ago, and we had a baby 2 years ago. We have a 2-year-old baby boy. So we have to go back and relook at what we had done and change those beneficiaries. So life changes. So we have to constantly keep estate planning in mind. A good practice is to look at it every 5 years. Unless there's a major life event that happens that would require you to look at it sooner. A good practice is every 5 years, just quickly look through it. What changed? We don't even think about what changes happen in our life. But as we go through that practice, that could avoid big mistakes down the road, and we can get our estate planning updated as we move along with our life.
That's good stuff. Good stuff. Well, thank you, Dewan. We really appreciated you being here today. Frable, do you got anything left?
Well, no, he definitely knows a lot more about this area than I do, which is why I didn't say a whole lot. And this just kind of goes back to speaking about why it's important to have good quality teammates and partners and in a firm like ours, because you don't have to know it all, and you can rely on your teammates that have more knowledge in certain areas. But so Dewan, amazing, and we appreciate your wisdom and your knowledge, and you are very deep with your comments there that life changes. And you may think you have it under control with some of this planning one day, and then the next day it always changes. It can change. But the other part is that it's important to take a step and start doing something. It's amazing the people that we run into, especially when we're talking to prospective clients, and it's like, you don't have a will or a trust in place, and nope, never thought about it. And you were talking about the probate and the situations where you hear about court proceedings and issues on an estate. Usually it's because there's no will or trust in place there. And then people start fighting and it gets kind of ugly. So the things that we're talking about today are extremely important, whether you're a business owner or just an individual, for sure. So yeah, we definitely appreciate your wisdom and knowledge there. And as we wrap up, it is time for Sarah's special segment of
Rapid fire.
So get ready, Dewan. Strap in. Sarah's got some really difficult questions for you. As we
Okay.
Yes. All right. So Dewan, what's your favorite American food?
Burger
A burger, nice. With cheese or without?
with cheese.
Absolutely.
That's the best kind. All right. Cats or dogs?
Dogs.
Good answer.
I knew. I always liked you, Dewan, until right now. You're not a cat guy.
I'll tell you this. I've had no pets growing up. And I know we're towards the end. I don't want to expand this. A couple of years ago when, we got married, my wife and I, we decided, and it was the same for her. We decided we're going to have pets, and we were looking at options. We ended up with a goldfish. So that's how we started having pets. So I've never owned a cat or a dog. I'll start there. But from the friends and family who owns dogs and cats, I just see dogs are friendlier. So I'm coming from that perspective. Just FYI.
Dewan is such a practical individual.
I know. So good. So good. All right. What's a bucket place or a bucket list place that you want to visit that you've not visited yet?
Thailand.
Oh, nice. Okay. All right. Are you a morning person or a night owl?
I am pretty good with both. I would say night is natural for me, at least. Yeah, I would say night for sure. Because again, like thinking back to college days, morning was tough. Now, both are equally fine. Whether I want to wake up early or not, my kid wakes me up and I'm still fine the rest of the day. So I would say naturally probably a night person.
All right. Good deal. And last, what animal or insect or reptile are you afraid of?
Ooh, that's a good one. Snake, probably.
That's a good answer, me too. Anything that slithers.
Right.
I'm afraid of human beings.
Frable.
Well, Dewan, thank you for spending time with us today. We appreciate, again, your wisdom and your knowledge, but also hearing the journey that you've been through. I think that's one of the most interesting and unique things about you is how you came over to the States, how you developed your career, and how things are really literally different for your family now than they were back when you were a kid. So that's just an amazing story. And we are very happy and very fortunate to have you as a partner. So we appreciate all the work you do and the impact you have on our teammates. So thanks for joining us today. And thanks to our listeners for joining us today as well. If you want to email us, you can do so at podcast@cckcpa.com. Let us know what we're doing right, what we're doing wrong, maybe what you might want to hear us talk about. Or if you were listening today and you thought that Dewan sounds like one knowledgeable dude and I don't have a will or trust in place, email us. We will get you in touch with Dewan, and he will take care of you. Special thanks, as always, to CCK as our main sponsor for giving us the opportunity and the platform to do this. Christy, thank you for joining us today. You didn't say a whole lot, but we must have been right on track, I think, right?
Absolutely. Like you said, Dewan is so knowledgeable. And my favorite part, and Dewan, don't take this badly, your laugh always brings me joy. So I love it.
No, thank you. I appreciate you all having me here today.
Thanks also to Robert Mays for the intro and outro music, and for Clarence Fisher with Tulsa Internet Marketing Services for all the editing that's done in the background, and Emily Johansson for getting us on the air and doing all the background stuff. So again, thank you for joining us today. We look forward to the next time that you join these two CPAs as they get together to have a chat, and you get to find out who's on the mic.
The information provided on this podcast is for general informational and educational purposes only and does not constitute accounting, tax, legal, or financial advice. While we strive to provide accurate and up-to-date information, laws and regulations change and individual circumstances vary. Always consult with a qualified CPA or professional advisor before making any financial or business decisions. The views expressed by the hosts and guests are their own and do not necessarily reflect the opinions of any organizations they are affiliated with. Listening to this podcast does not create a client-accountant relationship. By listening to this podcast, you acknowledge and agree to those terms. And that's a wrap for this episode of Two CPAs and The Mic. If you found today's episode helpful, please subscribe, share, and leave us a review. Have questions or ideas for a topic? Reach out. We'd love to hear from you. Email us at podcast@cckcpa.com.